Okay, welcome back, everybody. I hope you found your breakout session that you attended to be informative, and you hopefully took something away from that. Want to get started now with the Show Me the Money panel. We have three lenders here today who are going to address the financial side of livestock production. And we'll just kind of go in order of what they are in your program. And again, all of their bios are in that packet of information that you have in front of you. So I don't want to take up a lot of their valuable time to go through the bios. The first speaker is Jayme Ungs with U.S. Bank. And then we'll hear from Patten with Farm Credit Services of America. And then finally, Tim Meyer with Producers Livestock Marketing Association. And then all three will be up here for a question and answer session. So be thinking of some questions to ask these guys. So with that, I would like to introduce Jayme Ungs.
Well, thanks, Brian. I appreciate being able to come to this afternoon, and I'd like to welcome everyone here, and thank you for your attendance. My name is Jayme Ungs, and I grew up on a livestock farm and actually threw up a picture of my old stomping grounds in eastern Iowa, the dairy farm that I grew up on. And we ran a 100 dairy operation, and my family actually exited the dairy operation in 1988, February 12th to be precise, and because I will never forget that day because my jail sentence was lifted. We milked cows 8 hours a day, just my mother, my dad, and myself. And we had 100 cows and 100 stanchion barn, and it was work. And so I applaud everyone in this room who's got livestock, because I've been there, done that. Whoops. A little bit. So I grew up on a dairy farm just outside Dubuque. I also came, we had, as well as dairy, we had, we farrowed to finish a few sows, and we fed cattle, and we were the diverse family farm. Raised hay, we had 200 acres of alfalfa, spent my childhood in the summers just making hay. And I came to Iowa State, and I graduated with a double major in agriculture business finance. I also minored in agronomy and got an area of emphasis in farm management. One of our panelists earlier mentioned 6 years at Iowa State. I did spend 5.5 wonderful years at Iowa State, but again, like she mentioned, I actually took me a little bit longer than most just because of the extra degrees. After that, I did work in the seed genetic industry for a while. I managed a corn research station for Northrop King Seeds. I worked for Murphy Family Farms in contract hog financing. Selling barns and financing barns up in northwestern Iowa is where I spent most of my time, so I got very familiar in the hog business. And then I've been in ag lending for the last 17 years, of which the last 8 years of those have been with U.S. Bank. And during that time, I've had the honor to work with about 75 different producers. I was managing roughly about a $75 million loan portfolio. And recently, I've taken on a new position with the bank where I actually oversee a territory and support our other ag lenders throughout the entire state of Iowa, southern Minnesota, and central Illinois. So my role has expanded from being a primary lender position to being more of a support, training, and kind of working with the other lenders. And I also have, in the past, I was on the Iowa Agriculture Development Division board. I spent 9 years on that board working with young farmer programs. I was actually chairman of that board for a couple of years and actually had the privilege of writing one of the tax credit laws that are here in Iowa for young farmers on cash renting ground. So I was proud to be part of that and happened to have won their Banker of the Year award in 2004, 9, 10, 11, and 13. So one of the things that I really appreciate doing is working with young farmers over the years. That's been really kind of a mission of mine and really looking at that next generation coming in. So that's been a real focal point for me throughout my banking career. And I do operate a small grain operation of my own just west of here a few miles in Boone. And we grow all corn, and that's kind of the crop of choice for us because we're so close to all the ethanol plants. One of the things that we wanted to talk about a little bit today was just what are we as lenders looking for when someone wants to come in and either start or expand an operation. So really, I'm going to go through some kind of the basics, and then I'd love to entertain questions anywhere along the way if anyone has them. But really, kind of the really fundamentals of what we're looking for is really past financial information. 3 years of tax returns, 3 years of balance sheets, and in all honesty, quality balance sheets. As lenders, the more accurate information we can have, the better the decision-making process can be. A very detailed information helps us answer a lot of questions that are out there. If it's kind of scribbled on the back of a napkin, it doesn't. When you're asking for maybe millions of dollars, it makes it hard for us to disseminate what the risks really are to the operation. One of the biggest things that we really look at for U.S. Bank, we're cash flow lenders. So we really want to know what it's going to take to cash flow, and we really expect our borrowers to understand that too. So knowing the cost of production, do we know if we can make money doing something? We all understand that things happen, but at the end of the day, the plan should be to make money, and we don't want to just, I guess, for lack of a better term, wing it. So we're really looking for customers that can come in, understand what their cost of productions are, and then we can make reasonable cash flow assumptions with that. And then that gives us a lot of confidence in where the operation is, where the operation is going, and really what kind of debt expansion can that operation handle. So if we have a producer come in and say, I work with Nick from Mashoffs, and if they want to come in and put up a hog barn, and we're like, great, that's a great idea, but they have just absolutely no understanding of how that affects their operation, well, that's a big risk signal to us at that point, and we really need to get a grasp on whether that's going to work or not. Had a conversation with a borrower this morning who's eagerly entering into the livestock arena, and they're kind of doing it. He's not really doing it with a plan. We talked about business plans earlier, and we had to have a real hard conversation with him this morning about the fact that we can't just keep buying stuff hoping that it works. We have to have some kind of idea if this is really where the operation can handle it. And I'll talk a little bit more about an example like that later. The other thing is, one of the main jobs that I have as a lender is really risk management. That's what my industry is about. We have to manage all different sorts of risks. Now, the risks for the bank are different than the risk for you, but somewhat the same. We have to manage the risk of our cost of production and our net margins, just like any other business would. So, that's what we really look for in the borrowers that we work with. So, part of those risk mitigants is what tools are we using to mitigate those risks? What insurance policies are we using? What hedging techniques are we using? Maybe what kind of contracts are we using? Are we forward selling anything along those lines? And a great example of that is I had a young producer come in the other day, and he's got a hoop building that he put up for cattle, and he wanted to talk to me about filling that hoop building up. It sat idle here for a while as he didn't want to take on the higher price feeder cattle. And we sat down, and he said, well, now I've got some feed on hand. I made my hay for the summer. I've got some silage on hand. I need to use this building. What can we do? And he said, I want to go out and buy some cattle. I said, okay, well, what's it going to cost us to feed those cattle? And to his credit, he came in, he had all the numbers laid out, and he was absolutely on target with what he needed to do to make money. I said, okay, well, you're 24 years old, you want a couple $100,000 for feeder cattle, you don't have the room for a bad year. So how are we going to mitigate this risk? And to his credit, he said, you know what? I can go out and I can buy put options today, and I can guarantee that these cattle will break even after I factor in the cost of the hedging. And I said, well, can't argue with that. If you can guarantee that you won't lose money, I said, fill up the lot. So I gave him the green light to go out and fill up the lot because he had come in with a plan. He didn't come in and just say, well, I want to go out and feed cattle. He came in, I know what it's going to cost me. I know what it's going to cost to feed them. And I'm not going to buy cattle for more than this much, and I can go out and hedge them, and I can make this much money today, or at the very worst, I cannot lose money with my hedging. Well, you know how much confidence that gives me in him? So, that's the difference between with working with risk mitigation is we get a lot more reasonable to work with at that point, because we know that you've done your homework and you're taking the appropriate steps to make money. So, the other thing that we kind of look at is really kind of some of your experience levels with livestock. Cow calf is kind of hot right now. And if anyone's looked at the cow prices, you totally get that. Well, it's kind of hard for me to get 100% on board with someone who walks in and their family's never raised cattle, they've never raised cattle, and then all of a sudden, hey, we want to go out and buy $300,000 worth of cows, and we've never calved cattle before in our lives. I'm sitting there going, well, what's your experience at doing this? And maybe at that point, we got to put a toe in the water before that we dive into the pool head first. Because it's one thing to say on paper that things work, but as we all know in the livestock industry, things can go wrong and animals die. Well, if you haven't had the life experience of kind of taking care of things, the money looks good at first, but I want to know that you have the ability also. It's not just about the finances, but is the ability of the borrower too. Access to markets, especially when we're looking at maybe some more specialty items. Not so much with the standard cattle, with the standard hog kind of deals, but there are some specialty niche markets out there. For example, like antibiotic-free hogs. Those are things that when we're looking at those kinds of deals, I don't want to just know what the cash flow is. I don't want to know just the numbers. But the reality is what kind of markets are out there and what's the stability of those markets. Because if you have to make a long-term investment in facilities, we really want to know what's the sustainability of a project like that. Dr. Cole talked about business plans. Well, what are the long-term goals? What do you want as a business? That helps us to look into the future and help you plan accordingly. So I work with a lot of young producers that put up contract hog buildings, and we have to talk about why do you want to do this? Why is it the right thing for you? Because even though they're great projects, that doesn't mean it's for everyone. And so we're really kind of understanding, where does this fit in your operation? Where do you want it to go down the road? Also, 5 years from now, you want to do this. Well, how does taking on the debt today really affect how you're going to do things down the road too? Because we need to know what your goals are too, so that we can adequately plan and structure operations for the future. Again, we're trying to give a little vision to it and trying to understand what the real end game is for a lot of our customers. And then we want to help them get there. And so we can help lay out those plans from a financial standpoint. The other thing too is a lot of people don't always put a lot of thought into, if I want to put up a confinement operation, am I going to be over that 1,000 animal units? What are my neighbors going to think? And I've worked with a lot of people who have done this, and the first thing, honestly, I'm going to recommend is that they work with a coalition to try to figure those things out. Because doing your homework ahead of time is extremely important. A good example, we had a young guy who wanted to put up a 3,600 head hog facility. And a lot of neighbors around, not very far away from a decent-sized town. And we all know how certain groups in the state of Iowa love livestock today. So I had a long talk with him after we said, yeah, it's financially feasible. Then the next step was, okay, there's a battle that's going to come. And he wasn't really sure what that all meant. And I said, well, trust me, working in the hog industry, being around livestock, there's a battle that's going to come. And so I encouraged him to work with Kent and Brian and their group. And they kind of found out that working with the neighborhood before they started construction was very helpful. They went out and they talked to their county supervisors. They went out and talked to the neighbors. And they really got their story out there, and that they were a good young family, respectable, going to do a good job. And they got that story out before the fearmongers got their story out about livestock. And I can still remember sitting in that 4-hour county supervisor meeting with all the debate over it. But at the end of the day, the supervisors all voted unanimously to approve it. Now, granted, the supervisors didn't have the final say, but that was a great show of support. And I applauded that young family for doing their due diligence before they started the building. I've seen the opposite. I've seen operations where it's just like, we don't care what anyone thinks. And they just plow forward and start the construction. Well, sometimes that goes okay and sometimes not so good. And, you know, I think from a PR standpoint and an acceptance standpoint, it's great to be out in front of it with your own story instead of letting someone else tell your story. So just a little plug for these guys, because I think they do a great job in helping people ahead of time understand all the hoops that they have to go through. Because if you've never done it before, it can be an intimidating process if it's not done correctly. You know, that goes again, communicating with your neighbors just so that they know what's going on. A lot of times once you tell them their story and they understand, most people are good with it. I'll give you a good example, because I found over the years that a livestock facility smells the worst before it's ever built, just from a perception standpoint. I've got to share this story because I think it's a good example. One day I was working for Murphy Family Farms, and I was in the office early that morning, and the phone rings, and I made the mistake of picking it up. And had this lady who just started tearing me apart for being the scourge of the earth working with livestock. And now I managed the kind of construction process and pig flow for Murphy Farm, so I knew where all the buildings were and I knew what stage of construction they were in. Well, she spent a half hour just telling me how bad it smelt and how bad this and that and how awful we were. And when she finally took a pause, I asked her if I had asked her if that was what she wanted to express. I might have been a little bit more blunt than that at that point. But I was courteous to her, and during this tirade, I had figured out which building she was talking about. And I mentioned to her, I said, well, ma'am, I appreciate your concern, but I can tell you right now it's not our building you're smelling, because that building is still under construction, has never had a pig in it. And all it was click on the other end. And it was just someone who just didn't like the thought of the hog building being there. There was no science to it. There was no facts. And you know what? After the building was built, everybody was fine with it. Once it had pigs in it, you know, all that perception ideas went away. So that's why I say, you know, get out and do your homework first and be proactive with it. So some of the common mistakes that we see in especially construction of livestock facilities, you're going to assume it's going to come in on budget, and I'm going to tell you it's not. You know, as a lender, we always budget additional money. Case in point, I had a guy that put up $1 million facility, and he was pretty optimistic that it'd come in at $1 million, and I said, nah, we'll budget more. He's like, oh, no, we'll be in on budget. Well, 2/3 of the way through the project, they were on budget. And he was like, oh, man, we're under budget. And I'm like, yeah, okay, well, if you come in under budget, that's great. Well, the last draw on his construction came, and he came into my office, and he was pretty sheepish about it. And I'm like, well, what's going on? He's like, I told you it would be $1 million, and it didn't come in $1 million. And I said, okay, and he's like, well, aren't you mad? I'm like, well, how much was it? He said, well, it was $1,050,000. And I said, well, that's fine. I budgeted $1,001,000, so we're good. And he's like, well, but I thought we were going to be under budget. I'm like, experience says you won't be. And what happened was, during the middle of the summer of 2014, he had this big hole in the ground that became a swimming pool for 6 weeks. Our area was 148% normal rainfall. So we had a huge delay in construction, huge extra cost for trying to do dirt work around it and everything. So, I always encourage people, budgets are budgets, but you need to be realistic that at some point you're probably going to have some cost overruns. And you need to kind of plan for them because you don't want that to be a big surprise at the end. I had a turkey facility one time where it ended up being $100,000 more than planned on an $800,000 deal, and it was all because the contractor had kind of built in the cheapest barn they could have, and then halfway through the process started going, well, if you really want it done right, you need to do this. And then the change orders started coming in, and that just blew the budget out of the water. Some of the other assumptions. Good times are here forever, and conversely, bad times are here forever. The bad times are here forever. What that really kind of does is it stymies your outlook, and it can really weigh on just your fundamental attitude towards what you're doing. That's not as bad as when you have the feeling that the good times are here forever. Ask any $7.50 corn grower today. We all kind of knew that a cycle was coming and that it would end at some point. The idea there is accept that it's a cycle, plan for the cycle. I can remember sitting at Iowa State in 1995 in a graduate level grain marketing class, and corn had reached $3. And I can still remember the professor saying, corn is at a new plateau. It will never go below $3 again. And then as a lender in 1998, I think it was like $1.60. So, cycles come and go and they change. We have to understand that. Now bad times don't stay forever either. So, and sometimes that's one of the best times to get in. I will admit, in 1997, I was working for Murphy Farms. Life was pretty good. Hogs were doing well. 1998, I was not working for Murphy Family Farms. I was working for a bank financing, for those of us who remember, 8-cent hogs. That, talk about cutting your teeth. I learned a lot about financing 8-cent hogs at that point. I even had a producer one time tell me a joke. He said, I went to lunch in town, took my livestock trailer with me. Went in, my livestock trailer was full. Came out, it was full of pigs. Still lost money on them. Those were hard times, but the hog market got better. So again, it wasn't that the bad times were there forever, but because of the cycles, these are the reasons we look at risk management so much, because it's never as good as it is forever, and it's never as bad as it is forever. So we learn how to manage to the middle. And with good risk management tools, you can do that. Again, not being proactive with neighbors on siting livestock facilities is a big deal. I can't emphasize that enough, because if you can get your neighbors on board with you, I don't worry about the protesters that show up from 100 miles away because they don't live in my neighborhood. So the first thing I want to do is make sure my neighbors are on board with me. Hurdles for the young farmer. Let's face it. Most of it just capital. Yeah, you need to know your cash flow and break evens, but the other one's capital. So the young farmer, what's the least thing that he has typically is the net worth and the capital and the backstop to the risk that they're trying to undertake. It's not when you're just out of college or you're just coming home or you're, just out of high school, wherever your stage is when you're trying to start into farming. Try to go out and buy a farm today or try to put up $1 million livestock facility if you don't have a large amount of cash built up. And let's face it, when you're 20 years old, you just don't have that. So on the grain side, that's been extremely difficult for young guys to get started today because the capital required is just so intense. I think that's why you're seeing a lot of interest again in livestock is you have a lot of people that want to come back to farming, and honestly, livestock's one of the best ways to do it. You don't have to go out and spend $1 million to get started. You can start out with 20 cow-calf pairs. You can feed a pen of cattle, which I guess that's not as cheap as it used to be either, but you don't have to make the huge investment that is there. Now if you want to do contract feeding, there's a fair amount of capital investment that still has to be done with that. But there are ways to work around some of those capital deficiencies as a young farmer. But the big key is point number 4 there is if you don't have the capital, you better know this rest. You better understand your risk positions. You better understand what your break-evens are and your cost of productions. And how can we manage that? Because without the capital behind you, you just don't have that risk tolerance that, say, a more well-established farmer who's been doing it for a few decades has. And so those are the risk mitigants. And now, I work with a lot of young farmers. The average age of farmers is estimated at roughly 58. We did an analysis of my portfolio at one time, and the average age of my borrowers was 42. And I'll tell you right now, I had 30 guys under the age of 30, and most of them were borrowing close to $1 million. So it's not that it can't be done, it just has to be done in the right way. And the key component to all their success was they were extremely good business managers, they knew their numbers, they were well educated, and they were willing to take on the risk management techniques that are available to the market today. They had, the things they had in common was they had well thought out plans. They didn't just come into my office and say, well, you know what, I'm done with college, I don't really know what I want to do, so I think I'm going to farm. Nope, it was, we're coming back to the farm, and Dad said that we need to figure out how to increase income. This is what we want to do, this is how it's going to work, and this is how we're going to make it work. So right there, I'll tell you what, I'm impressed with anyone who walks into my office and has that plan put into place. Because I know that they've thought about it. I know they've thought it through. I know they know their stuff. They're understanding their numbers. We're, in the grain side, we're back to reality. $7.50 corn, boy, it was hard not to make money. You just had to get up. If you showed up to the game, you were making money. So there wasn't really a whole lot of thought that went into a lot of things at that point. The old adage, a rising tide raises all ships, was pretty true. Well, $3.50 corn, we need to know how to make money again. So we're back to margin management. And so same thing goes in the livestock industry too. So I encourage everyone to know those numbers. What are we doing to mitigate our risk? If we want to diversify our farm and we're doing a contract hog barn, okay, I understand that. Now, that being said, the contract is only as good as the company writing the contract. So whenever you're dealing with maybe an independent producer that wants a contract, a barn with you, you kind of need to know a little bit who you're dealing with. So make sure not all contracts are created equal. What is the backup plan? What if I have a bad year? How am I going to handle it? Or what if this just doesn't go the way we think it's going to go? How do we get out? Getting in seems hard, but sometimes getting out is even harder. I had a young producer one time, he lost half his net worth in 1 year row crop farming. And I basically told him we were done financing him. And I told him, I said, I'm not doing it to be mean or stubborn, but I said, you are projected to lose the other half of your net worth in the next year. I tell you the truth, I'm doing you a favor right here by not renewing your line of credit. And he kind of got it and he didn't see it. I said, well, if you lose the other half of your net worth, you are broke. Why did you work so hard to get there? And he's like, well, I can't give up the ground. I can't give up the ground. I said, well, why do you need to make your landlord rich? I mean, his landlord was sitting 1,000 miles away in a different state. We don't need to make him rich. You need to think about your wife and your kids, and you need to preserve your capital. Well, he reluctantly did that. And honestly, he'll never tell me this, I'm sure, but I know he's better off today because he actually is making more money now than when he was row crop farming. You know, the other thing too is willingness to use some government programs. I had a young guy yesterday, he's like, well, and this means like farm service agency programs. We do a lot of FSA lending on the young farmer side, and some people don't like it. They hear the word government and immediately they kind of cringe. Well, FSA has some really good young farmer programs, and so I really encourage the young producers in this room to understand them and investigate them, because we've used them to help a lot of young producers expand their farm operations. Case in point, I had a young gentleman who ended up buying 160 acres for $1 million, and this was a few years ago, and we did that with a $50,000 down payment. We used every government program under the sun to make that work, and we were able to get that done for him, and he's been extremely successful since, because the thing he didn't have the capital, but he had the cash flow. He knew how to make money. I mean, he had other enterprises. He's selling seed, he's moving snow, he's custom spraying, so he had the ability to make money. Just at that point in time, he didn't have the $300,000 down payment. And since then, you know, we've grown him from farming 500 acres to 2,200 acres. He's been very successful. So that's why I say those young farmer programs that are out there are very helpful in trying to grow an operation. You know, some of the things we do, especially in the livestock arena, is we do a lot of construction lending. We do permanent financing. But we are a cash flow driven lender, so we don't just look at your equity position. We want to see what kind of debt service can you provide off of the operation that you're looking at. And so what we will do in lieu of that is with strong cash flows, we're willing to take on a little bit more leverage with good risk management plans. So a young producer that might not have that equity position to put up that hog barn, but has a good cash flow and we've got that contract payment backing it, we're willing to step out a little bit more. We might use some government programs to help back that up, but it's definitely something where we can really work with someone, because we're not looking at how much equity as the repayment on the project. We're really looking at how much cash flow is this operation providing to make those payments. Because like I told one producer one day, he said, well, the equity in my farm went up. And I said, well, is that great? Did you put a for sale sign in front of it today? Because that equity doesn't repay the bills that you have right now. You know, equity is not operational cash flow. That's great that his equity position was going up, but really at the end of the day, it's how much cash flow is paying all this back. You know, we use a lot of the young farmer loan programs through the IADD to help reduce interest rate costs. Those have been very beneficial over the years. We've done a lot of those. We have a lot of experience in livestock facilities. I've done quite a few of them. I've currently got 20 hog barns under finance right now. We have some mono slopes. We have some hoop buildings. And so we have quite an array of different livestock operations. You know, just for example, these are a few of the projects that we've financed just in the last year. And so we look at all different types of deals. And, you know, one of the things that we have, I'm proud to say, is we can really lend anywhere. U.S. Bank is in 25 different states. We do a lot of ag lending throughout our footprint. And so we're not limited in any scope. We're not afraid of anything. And we'll finance whatever project seems reasonable from a cash flow standpoint anywhere. So I guess that's kind of what I had. And Brian, I didn't know how you wanted to do this, if you wanted to take questions now or if you wanted to wait till the end or. Okay.
Okay, good afternoon, everybody. Can you hear me? Is my mic on? We're good? All right, my name's Al Patten. I'm going to stand down here on the floor, maybe roam around just a little bit. I'm with Farm Credit Service of America, Vice President. I lead our offices in Storm Lake and Webster City. I'm going to steal something from Dr. Cole. When we're at conferences like this, we had a big meal. We're sitting in that afternoon session. I know we get a little bit sleepy, so everybody stand up. Everybody stand up, stretch a little bit. Dr. Cole would say we got to stretch. All right, shake hands with your neighbor. Introduce yourself to somebody you haven't met here yet today. How are you today? God, very good. Very good. Good afternoon. We got clickers up here. Great, thank you.
Yep.
All right, we'll keep moving here this afternoon. It's my pleasure to be with you this afternoon. I've got a lot of slides that have probably been covered already today, so I'm going to go through my slides pretty quickly. You've got them in front of you. If you have questions, please shout them out. I'd be glad to take questions as we go throughout the session here, so shout them out at any time. I'm going to just talk a little bit about the state of agriculture and kind of where we see it as being at today. Certainly that's different from the grain industry than it is for the livestock industry. I'll touch a little bit about some opportunities that we see, and I think there's a lot of those going on in the state of Iowa right now. And then I'll just talk about a few considerations to think about whether you're in livestock today or you're thinking about getting in. So I'm going to start you off today with a question, okay? I want you to think about traffic signs, all right? Specifically, yield traffic signs. You know the triangular ones? Yield traffic signs. What color are they? Yellow. I heard a little red and white. I heard yellow. Well, I'll bet most of us would probably say yellow, right? Actually, today, they're not yellow. They're red and white. So whoever said that is pretty perceptive. Do you know when we changed from yellow and black yield signs to red and white ones? 1971. 1971. Okay? Sometimes things change right before our eyes and we miss those things. And boy, there's a lot changing in agriculture right now that we got to make sure we're not missing, because it causes us to have to make changes in our operation. And if we just sit on our hands and we don't make changes, especially with what's going on in the grain industry right now, boy, it's probably going to be painful. So we got to pay attention to what's going on. What's been happening in agriculture the last several years? When we started building ethanol plants in 2007, that changed the game for corn. We significantly increased the demand for corn, and we couldn't keep up with it by the acres that we were planting. Then came along the drought of 2011 and 2012, and we had this scenario where demand was just completely overwhelming supply. It was not a great time for the livestock industry. We had a lot of volatility going on and some pressure on profitability. But all that has kind of reconciled itself now. That trend has reversed, and we've got lower feed costs today, don't we? So all this bodes very well for the livestock industry. That's happened not only domestically, but globally. We've planted enough acres, we had big yields in 2014, and supply finally caught up with demand. It's a great scenario for the livestock industry. Now, as you look at what's on the horizon for corn in the United States, there's not a something else that's hanging out there that's going to be a big demand driver. Ethanol's not expanding significantly. Livestock's not expanding significantly. The dollar's getting more expensive, so exports aren't a big driver. And it looks like we're going to continue to have relatively low corn prices. This is a balance sheet from WASD. This is the December numbers. They actually updated them in January, but the numbers are still pretty close. You've got them in front of you. I don't know if you can see them on the board up here or not, but I'd point you towards the numbers at the bottom. The ending stocks numbers and the stocks to use ratios. In 10, 11, 12, and 13, the ending stock to use ratio was single digits. Okay, it was 8, 9% in there, give or take. And now, where we're at today, it's somewhere between 14 and 15%. We all of a sudden have this big supply of corn and we don't know what we're going to do with it. The last time we had ending stocks to use ratio at approximately the same level was back in 09 when they were 13%, and look at what corn price was, $3.50. WASD's updated January numbers says the average price of corn for this marketing year is $3.65. Okay, so that's the price we kind of have to, the plateau we're at right now, we're going to have to live with. Probably not great news if we're in the grain industry. Might be very good news if we're in the livestock industry. This is a chart from Informa, Pro Exporter. It has USDA numbers on it and FAPRI as well. So you got four kind of the leading exports and their predictions for corn price over the next 5 years. Now, what the chart tells me is nobody really knows what's going to happen to corn price. There's a lot of inconsistency with this. But if you look across there, and if you could draw a line, you would probably say that for the most part, they're all projecting corn to be $4 or less for the foreseeable future. Okay, so that's a little bit of the era that we're in, $4 or less. If you're in the livestock industry, that's really good news. One word of caution that I would have is don't fall asleep on feed costs. Yes, DDGs can be very attractive right now. Corn is at these low levels. Meal is good price too. But don't fall asleep on these feed costs. We know that there's times in the state of Iowa that we're corn deficient. And the feed mills and the ethanol plants, when they need corn, boy, they got to bid it up, don't they? And if you're selling corn, boy, you can catch a pretty nice basis. Sometimes even a really healthy positive basis. If you're buying corn or buying feed, that might not be so good. So just because we've kind of got this new era in feed costs right now, don't fall asleep at the wheel. Make sure you continue to manage these feed costs. Just kind of sum up where we're at in the protein industry, it certainly looks like the short term is very, very good. I think our profitability that we're seeing today in the livestock industry is going to continue. We're going to have to be careful with some things as we go long term. Let's face it, our products in the grocery store keep getting more and more expensive. I like this chart a lot. It shows the relative cost of meat in the grocery stores and what it's done over the last few years. If you look at the red and blue lines, that's beef. The pink line in the middle is pork. So compare those two to chicken and turkey. And you can see that the relative cost of our meat is getting more and more expensive for beef and pork. Two things that industry is going to have to really be careful about to make sure we don't begin to just erode our demand for our product in the grocery store. I'll shift gears a little bit and talk about some interest rates. We all know that short-term rates have been at historically low levels for a long period of time. Probably going to be some pressure upward on interest rates, on short-term rates in the near future, but certainly we've enjoyed the benefit of low short-term interest rates. Long-term interest rates have also been good. I've got some numbers up there, but today, long-term interest rates, 10, 20, 30-year rates, are just about as good as they've been in our whole entire lifetime. Literally as we sit right here today. So if you're thinking about investments in livestock and livestock facilities, as far as borrowing money at good interest rates, there really couldn't be a better time. Now, this is the chart from the Federal Reserve on Fed funds rate. This is the short-term rates. And what I want to point out here, again, we've had this unprecedented time since 2009 of really, really low short-term rates. But when you look back at the times that the Fed has changed rates, look at what's happened. It's been rapid and it's been significant. Okay, whether it's gone up or down, it's been rapid and significant. The Fed has said they're likely to start changing to increasing rates in 2015. That's going to increase your operating costs. It's something you have to plan for as we go forward these next few years. Here's the chart on long-term rates. This is the 10-year Treasury rate going back over the last 15 years. Okay, if I went back further, you'd still see the same thing. We're almost at record level lows. The 10-year Treasury yesterday, I believe it closed at 1.9%. So if you could go back, the low we hit was there in late summer of 2012. We're almost back to the lows of our lifetime on these long-term interest rates. So if you've got money on a variable rate, you've got money on a short-term rate, you're thinking about doing something new today, now is a great time to get that money locked in. It'll probably be the lowest rates you ever do in your lifetime. I'll talk a little bit about some opportunities as we see them and what's going on in the Midwest, what's going on in the state of Iowa right now. These are some things that I think are attractive for you as producers in thinking about getting into livestock right now. I'm not necessarily going to touch on every one of these, but I think each one of these industries right here has things happening in the state of Iowa right now that are creating opportunities for you as growers and producers. So it's a great time to be involved in livestock production. Clearly, we continue to have a migration of livestock to Iowa. We have the cheapest feed of just about anywhere. We have the land availability for manure disposal. In fact, we love to have those nutrients. We have the packing capacity, and in general, we have pretty favorable livestock regulations. All those things continue to bring livestock to the Midwest and to Iowa. It's the swine industry is expanding. We've been trying to figure out in the swine industry how to handle PEDV, and that's had our main focus for the last 18 months or so. In the meantime, we've made good money in the hog industry, but I think the industry has finally said we need to start putting in some more sows, and that's happening. The last Hogs and Pig report, you saw that sow numbers are up, and that's going to create opportunities for you. We need more finishing space in Iowa. It's going to happen. How many sows we put in and how well we get to the point that we control PEDV is going to drive how much space we need. But I've talked to 3 integrators in the last 30 days, and they all need a significant amount of space in the state of Iowa. So those opportunities are out there. As far as the migration of cattle into Iowa, that's happening too, not necessarily at the same rate as it happened in the swine industry. But clearly, we have cattle that are coming back into the state of Iowa. We do have some capacity. We have some feedlot capacity in Iowa. And again, we've got awfully good feed costs and some other things as well. One of the biggest challenges about how much migration will get to Iowa is just there's so much feedlot capacity in the whole United States. Underutilized feedlot capacity across the whole United States. And that's probably going to be a limiting factor on how many cattle we actually do move to Iowa. But some of you are probably involved in some tests. You might have some cattle here in Iowa in some confinement barns. We're all trying to figure out, can we do that and be competitive with the feedlots in Kansas and Texas and Oklahoma? And we're all trying to figure that out. But if we do, and we feel like we can be effective in raising cattle in those confinement facilities, I think you'll see more of this migration to the state of Iowa. This is probably the other big challenge, no matter where you're feeding cattle at right now, and that's just cost of production. We talked about those $3 feeder calves this morning, and boy, it takes a lot of money to finance cattle right now. It's a high-risk business, there's no doubt. Clearly, we've made some pretty good money, but if I'm getting in today and I'm buying feeder calves for the first time, holy cow, it takes a lot of money, right? It takes a lot of money. So this is always going to be a limiting factor, whether we're in Iowa or Oklahoma or whatever it is, that's going to limit some of the feeding capacity or feeding potential. As far as emerging opportunities, I know we've all enjoyed having the opportunity to listen to Mark Nelson and to John Ray this morning talk about the aquaculture venture that's going on in Webster City. I happen to be from Webster City. I get a chance to see that closely. It's very exciting. It's going to create new jobs for the community. It's going to create new opportunities for growers. And so I won't spend a lot of time on aquaculture, but you got a couple of great resources here in John and Mark that I'm sure can help answer your question. You know, I see the aquaculture industry a little bit like we saw the swine industry in about 1989. And at that point in time, we started building some of the first Murphy buildings back then. Remember that? And boy, we all saw these big confinement buildings going up, and as lenders, we all tried to figure out how in the heck are we going to finance those, and There was all kinds of questions about it, but it was kind of an emerging part of that industry, wasn't it? And look where we're at in the hog industry 25 years later. So I really see that. You know, their business model, we're raising protein from grain in a controlled environment. Let's face it, we do that in Iowa, don't we? We do that in a lot of different industries already, the swine industry, the layer industry, the turkey industry. We do this in Iowa already. So the business model is already there. Dr. Cole talked about diversification today. I won't spend a lot of time on diversification, but clearly a good diversified operation of both grain and livestock is healthy. It's healthy for you as growers. It's healthy for both industries to have a good balance between the two of them. I think this is an important slide. And livestock industry right now is pretty good times. We're making some money in the livestock industry. We needed to do that because the previous 5 years have been a little tough. But right now, times are pretty good. We need to learn the lessons that the grain industry has just gone through, and that's preserving working capital and managing our fixed costs. We have to do those things. The grain industry learned that one. What did they do? When we make money, what do we do with it? We often spend it. Sometimes we spend too much. We replace machinery. We built grain storage. We built machine sheds. We did a lot of those things. That's a fine balance in there always. But I can tell you that there's a lot of the grain industry right now that says, I wish I would have saved a little bit more of my money. I wish I had that sitting in my working capital in my savings account. And it's a lesson the livestock industry's got to live right now. When we are making money, we've got to save some of that. As you work with your lender, I would just tell you, a lot of people, including Jayme, have talked about the quality of your financial information. You guys got to become good record keepers of your own financial information. You should know that way better than your lender. Don't go in and see your lender and give them your balance sheet once a year. You've got to know and understand your operation way better than your lender. So take pride in that and become a good steward of your own financial information. From a financial standpoint, be able to tell what's happening in your own operation today. Get on an accounting system that tells you this information, that tells you on a year-over-year basis, am I making money, am I not making money, where's my fixed costs at? Be able to benchmark yourselves against some others. Don't rely on your lender to do that. You guys need to do that. You need to know if your existing operation is working or not. If you're thinking about going into a new one, the first thing you got to be able to answer is, if my existing operation's not working, I need to get that fixed first. Don't count on all of a sudden filling up the lots with cattle or putting up a confinement hog barn, whatever it might be. Don't count on that fixing something that's already not working in your existing operation. Know your cost of production. Know your fixed costs. Kelly talked about this morning. Be meticulous and know those details. It's really important. The grain industry right now is trying to figure this one out. Their fixed costs, I like to say, are the three big ones. My land payments, my machinery payments, and my cash rents. And for a lot of the grain industry right now, they're too high. Because when I add my other costs and my fertilizer, my seed, and my propane and everything else, my break-even's over $4 corn. That's where the grain industry at. It might be approaching $4.50. And we just looked at some slides that said we're in an era that's probably got $3.50 to $4 corn. So we're going to lose some money. And we got to get those fixed costs lowered. So we got to work on those. And the working capital, it is your savings account. If the grain industry loses some money right now, how do they continue to make their payments? How do they meet all their expenses? Well, the way they do it is they take it out of their savings account. They take it out of their working capital. So if you don't have any working capital to take it out of, that's a problem. That's a problem. So again, a lesson for the livestock industry right now is you all are in some pretty good times most likely. Make sure you're saving some of that money and put it in that savings account because the cycle will come. We know that. Just a few strategies here. You can read the bullet points on the slide, but be a low-cost producer. Don't get yourself highly leveraged. Lock in those long-term interest rates. Build your working capital and understand your fixed costs. Get on an accounting system that's going to give you good information monthly, quarterly, annually, so you can manage your operation. Cycles will come. They've came to the grain industry. They'll come again to the livestock industry. Cycles are okay. They help bring us some efficiency. It's going to do that for our corn and bean producers right now. They're figuring out how to cut costs. They're figuring out that maybe I got a little excess machinery. I don't quite need that much. It's going to drive some efficiency. So as you all are growing your livestock operations, keep that in mind as you go. Just manage, be detailed, be on top of those expenses like Kelly talked about, and don't let your operation get to be inefficient. There's some uncertainties out there, no doubt. Dr. Cole talked a little bit about the oil price. It's causing concern across the whole world in our economy. Our dollar's getting more expensive. It means our products overseas are more expensive. We might not be able to export quite as much. So it is a challenge as we go forward. We've got some things that our industry is going to need to deal with, but I also think there's a lot of reasons to be very optimistic. I like this slide. Today we sit here in the world with about 6 billion people. 2015, we got 6 billion people. By the year 2050, we're going to have 8 billion people in this world. We're going to have a third increase by the time we get to 2050. And what do all those people want to do? They all want to eat. And a lot of that growth in population is coming from third world countries that are getting their economic house in order, and there's more of those folks that are moving into a middle class type environment, and they're going to eat better tomorrow than they eat today. And that bodes very well for agriculture. United Nations says we've got to increase our global food production by 70% by the year 2050. It's a phenomenal number. Phenomenal number. There's no better place to do it than the United States of America, and certainly no better place to do it than you folks right here in the state of Iowa. You're the ones that will benefit from that increased population and the increased demand for food. So I think there's a lot of reasons to be very optimistic about agriculture. The investments that you're going to make in ag assets over the next few years and over your career will pay huge dividends, no doubt. There's a little bumpy water right now for us to navigate. Certainly if you're in the grain industry, we've got to pay attention to those yield signs, don't we? We got to identify what's changing. If I'm in the grain industry, I got to make sure I'm making some changes. If I'm expanding in the livestock industry, I got to make sure I keep my financial house in order. But I think as you look long term, you folks are in a great industry. This United States of America is so well positioned to compete in the world market, and I think there's a lot of things to be optimistic about. So that's all I had. Anybody have any questions for me at this point? I'll turn it over to Tim.
Anybody need to get up and move around again, or are you good? All right, great. I know it's the middle of the day and we've been sitting a long time. I figured out I could have driven to Chicago in the amount of time that I've been sitting in this chair today so far. So I'll try to move forward quickly for you. But want to talk about our company, Producers Livestock Marketing Association. We're out of Omaha, Nebraska, and our commodity office is out of Sioux City, Iowa. We have evolved from the stockyards era, which a lot of you in the room will remember the stockyards, but some of you may not. But I want to talk about that. I want to talk about some industry trends that we're seeing, and then I want to end our conversation on risk management. I am a native of Northwest Iowa, Holstein, Iowa. I grew up on a diversified livestock farm. My two older brothers continue to farm that operation today. My dad brought them into the farming in 1976 and 1980. A lot of you remember what happened from 1980 to about 1986. So I came out of high school, and in fact, it was 30 years ago about right now. I was sitting at the kitchen table. I was a senior in high school. And Mom and Dad were looking at me like, well, what are you going to do? And I said, well, God, I want to farm. Everybody else is farming, you know. He didn't say no. He said, hell no. He said, you're going to school. So that was my introduction to the hard knocks of going to class and going to college. I didn't really want to do it, but once I got there, I fell in love with it. I came here to Iowa State, graduated in the fall of 1989, started working in banking in January of 1990. So been in the industry about 25 years and was in banking actually for 23 years prior to moving over to Producers Livestock. I let's see, I better move forward here. I run the Credit Corporation, which is a subsidiary of Producers Livestock. It's called Producers Livestock Credit Corporation. We go by PLCC, so you'll see that referenced here. We are based, again, like I said, in Omaha and Sioux City. Started in the stockyards. Our last stockyard operations were over 20 years ago. How many of you in the room delivered cattle to stockyards? Not very many. So kind of sad. It was quite a place. It was really a bustling little city within itself. And as a kid, I got to go with my dad. We'd take a straight truck with 12 fat cattle on it, drop them off early in the morning, go to the commission house, have coffee and donuts, go to the feeder cattle auction, buy 30 head of 6 weights, and drive back home. And that's how a lot of cattle were bought and sold. I see a few heads nodding in the back. So that's kind of a piece of history that's gone, but it's also still in a lot of people's minds. We cover a very large area. We cover 12 states in the upper Midwest, Missouri, Iowa, Minnesota, Kansas, Nebraska, Dakotas, get into eastern Colorado, eastern Wyoming, and eastern Montana. And we have a 7-member board of directors. We're the 27th largest co-op in the United States, and we are a member of what's called the NLPA, the National Livestock Producers Association. There are other organizations like ours in other states that we get together semi-annually to go over what's happening in our industries, compare notes, see what's working in one place, what's working in another. Our 3 divisions are livestock marketing, our commodity risk management division, and then PLCC, which is the credit division. Livestock marketing guys, we have agents who are located throughout those 12 states. Those agents are your right hand when it's time to sell fat cattle, place feeder cattle, deliver yearling cattle if you're a backgrounder. They can help you find sources for your cattle. If you've got some high quality Black Angus cattle and they need to go to Creekstone in Kansas, we'll send them there. If you've got, now we've got Tama that's open and trying to kill a few nice quality black cattle. We're going to try to get them in there. So the agents bring expertise. They look at what you have in your yard and they try to find the right place to get you the highest amount for those cattle. Likewise, on the pig side, we have agents who work on the feeder pig side, help you place your fats. Some packers like a really big hog. Some like a hog at 240. We're going to get the right packer for those pigs. That's where those agents bring some value to you. We have 30 agents throughout the company, 7 on the hog side, and let's see, that'd leave 23 on the cattle side. About 12 of those are full-time. The other guys are commissioned agents on a part-time basis who probably run their own cattle operation and do some work for us on the side. I run the credit division. Our volume, in the market side, we marketed 750,000 cattle last year and over 1 million hogs. Commodity office is out of Sioux City. We have a full-service office. We have 4 licensed brokers. They can help you with your risk management plans, any of your hedging plans. Right now, we hedge, of our business, 55% is in the cattle, 30% in the hogs, and 15% in the grains. We clear through FC Stone, and we offer a hedge contract, which I could spend 20 minutes explaining the hedge contract to you guys in full detail, but I'll tell you this, it's our most popular product. It was designed in the early 90s that if you want to market your cattle with Producers Livestock, with our agents, with us, we will offer you a hedge contract where you will contract with us for $100 a load, be it a live cattle, live hog. We'll pay your initial margin, and we'll pay your margin calls as those hogs and cattle are on feed. I was in banking 23 years. I probably referred 50 to 75 clients to the commodity office at Producers in Sioux City because I didn't want to lend you the money for those margin calls, and these guys would pay them. Now, what I said earlier is that you got to agree to sell your livestock through us because we've got to have those proceeds to take those margin calls back when the livestock is sold. But the advantage to you is you won't have to pay it. You don't have to feel it out of your pocket until those cattle are liquidated, hogs are liquidated. Very popular product, and it's one that once people sign up for it, they never stop using it. So I will tell you, I'm in charge of the credit, and I'm in charge of procuring our line of credit from CoBank in Omaha. Last year, we had an $85 million line of credit at CoBank. Today, we have a $235 million line of credit at CoBank. $60 million of that last year was paying margin calls for all of those cattle that were hedged at $1.30 as the board went to $1.60, or feeders that were hedged at $1.70 as the board went to $2.30. So we learned to pay a little interest on margin calls. But our team in Omaha, I have 8 lenders, or 8 staff members besides myself, 4 lenders and 4 other administrators. We finance 143,000 cattle today, 93,000 hogs, totaling about $225 million on the books today. We do have very limited operating products, term products. We leave that to guys like Al and Jayme. We're more of we're a cattle and hog lender. We want to be able to put wheels under things and get them liquidated. We don't want to write 5-year deals real bad, 20-year deals. Our feeder program is our bread and butter program. It is designed for most of you in this room who are probably farmer feeders that produce your own crop, fill that bunker with corn silage, or put up your bags, put up your round bales. This program is a very popular program because we'll lend you 100% of the cattle money, and you're going to prove to us that you have the feed, because you're going to grow the equity in those cattle with that feed. We need to work cooperatively with Jayme and Al and any other lender that's financing operating term real estate, because they're going to have a prior lien on your cattle, prior lien on your crop. But their crop's going into our cattle, okay? So we're going to ask them to subordinate the cattle. In exchange, we promise to cut the check back to them once we're paid off. That's either jointly payable to the bank and to you. The bank, we give the choice. Do you want it jointly payable, or do you want it just made out to the producer? Some of you guys wouldn't need a jointly payable check. But that way, they have the ability to control their feed proceeds that have been liquidated through those cattle. Because there's usually a pretty good-sized operating line waiting for that check. So this program is what we write about 60 to 70% of our business through the feeder program. Program fee, speak to that just a little bit. Our agents who are out there, if you're buying cattle today using an order buyer, if you're using someone to help you sell your fat cattle, you're paying a commission. If you're using us in credit and you're using our agents to help you source cattle, sell your cattle, the top program fee you're going to pay is $8 per head. If you do the math on your commissions, you're going to be ahead using our guys and using us. If you choose not to do that, we're still going to ask for $3 per head, because we still come out and do inventories. We're going to be doing some paperwork to get things taken care of. Feedlot program is also popular. It's more for the custom feeder. Let's say that you're living here in Ames, Iowa, and you just want to own cattle in the worst way, and you want to put them in West Point, Nebraska. So we're going to ask you to put $200 a head down for a finished steer, $175 for a backgrounder, and we pick on the Holsteins a little bit. We want $250 if you're going to do a Holstein. But we will then pay for the cattle, and we will then pay all the feed bills. We'll enter into an arrangement with that feedlot so that they send us the feed bills directly, and then we reciprocate twice a month or once a month, however often they want paid. The proceeds come back through us. We pay our notes off, and we send you the rest. Hopefully you get more than $200 back. But that's a very common program, our second most popular program by far. Again, a program fee applies. You can use our agents if you wish on the marketing side. If not, we still ask for that $3 program fee. Feeder pig financing is something we still do. I'll admit it's a difficult thing to find right now, independent pig producers. We have 2 pig producers that we work with today, and those 93,000 pigs. We've discussed different things here about, custom feeding pigs. The ownership of the pigs just doesn't lie in the hands of the producer very often. So we're not against writing them. We just don't get very many applications. And we just, we would love to do more, but today it's just the nature of that industry. Works very similarly to the cattle. The proceeds come through us, pay our notes off, and we send the rest back to you. I wanted to talk about a few things in the cattle industry, these slides are just a little bit dated, or December. These are price charts from the last 5 years. The thing I kind of want to talk about is, if you'll notice, 2010, 11, 12, 13, from the low of the year to the high of the year is usually around 20 bucks. We seem to bounce in a $20 range. And then along came 2014. We walked into 2014 at $1.30, and we ended it at $1.70. So we were at $40 on our increase in 2014. And I can't tell you that I know where this thing's going, because we're already got the board back to $1.50 in, 22 days? So we're going to touch on a slide here later about what that does to your bottom line, but the only line that kind of compares to it is, if you maybe look at 2013, we started at about $1.29, and we went almost back to $1.20 right quick in January, and then just kind of sawed around that whole year. So there's a lot of funds at play in Chicago. There's a lot of things happening that the oil industry has certainly worked its way into the fund play. It's just something that risk management we'll talk about later is a key. Carcass weights, you can see from about July 1st, we were running pretty seasonally, maybe a few pounds heavier. And then everybody figured out that, man, this corn is cheap, and boy, those feeders are expensive. And I'm going to keep feeding these guys because I don't want to go buy those high-priced feeders. So slaughter weights, carcass weights went up 30 pounds from July 1st to essentially December 1st. They are starting to correct. Seasonally they correct, and you can see as they go into the spring and start marketing lighter calves and whatnot, the weights will correct. But right at the moment, what everybody saw, that feed was affordable, the cattle were performing, we've had good weather. It was easier to keep feeding them if they were performing well than it was to go replace them. This is a slide that I wish I could tell you more about it, because I put it in there and I'm like, what am I going to say about that? But it's from FC Stone. And they're talking about, based on our placements, they're projecting marketings into 2015. So if you look at 2013, 2014, we kind of followed right down. Well, 2015, we didn't go quite as deep, and we're already started back up. So I think that's a little bit of why the market is reacting the way it is. There's just a lot of uncertainty. Our agents will tell you, and I talked to some today, in their minds, there aren't any fat cattle out there. That's what they say. We all know there are some fat cattle out there, but the numbers for the next 60 days look very skinny for market-ready cattle. So this, and to speak to that, we traded cattle today in the country at $256 in the meat, which translates to $1.61, and the board closes at $1.50 today. So we have a $10 basis, positive basis, and historically, we track this at our commodity office. Basis runs about negative 50 cents right now, negative a quarter, and we're running plus $10. So let's just hypothetically say you hedged your cattle at $1.70, which you could have done back in November for February. Today you sold those cattle for $1.60, and you got out of the board at $1.50. What did you get for your fat cattle? $1.80. Because you just put 10 bucks positive basis on top of your sale and made 20 bucks on the hedge. So it's a crazy good time to be hedged. Unfortunately, not enough people are right at the moment. But what I'm saying here with this slide is I think the cattle are going to come, and this summer could get pretty tough. I just don't know when or how bad. This slide here refers to finishing steer calves. It's a 10-year, 6-month slide. Of those 126 months, 49, wait a minute, I got to check my notes. No, I'm going to say the percentage. 35% of the time, the numbers are in the black. 65% of the time, you're in the red. A lot of those are very small. A lot of those are either side of, $10, $20, if you factored those out. So then I said, well, let's look at the $100 threshold. How many times did we make $100? How many times did we lose over $100? Ironically, 35% of the time you made over $100. 65% of the time you lost over $100 of those months that traded over $100 losses and gains. So they say there's 3 ways to lose money, and gambling is the fastest, women is the funnest, and feeding cattle is the surest. So we'll look at yearlings because it's even worse here. So this is a chart showing the exact same thing. We show negatives 70% of the time, positives 30% of the time. Now I should say both of these charts were with no risk management. You just bought the cattle at the market, bought your inputs at the market, and sold your cattle at the market. This was what those charts are showing you. So what we want to try to mitigate is those long red lines. And we'll talk about that in a little bit, and both of these gentlemen have talked about it too. So you can make money in cattle, but you've got to manage risk. Wanted to throw this up real quick about cow-calf. Those guys have done very well, especially lately. You can see those last 2 years blow everything else off the chart. 5 negative years out of 28, but a lot of years where you didn't make a lot of money either. The drought monitor, put that up there just for discussion purposes. I was recently in California last week for national meetings for the NLPA. And one of the moderators asked us, what is the most limiting factor to expansion of livestock in your region or growth of livestock production in your region? What do you suppose the guys in California said? Water. I mean, in Iowa, I'm used to going to a restaurant and they offer you water. And they bring you a pitcher of water. Went into California and you had to beg to get a glass of water. Seriously, they don't offer you water. These were pretty nice places we were eating at too. And I was kind of, can I get a water? And I'm like, well, okay. They didn't want to give you the water. So the Midwest, when that question was posed to us, our answer was land. Where do we find the land to produce our corn on? Where do we find the land to lease for grass? We work with a lot of people in Nebraska, the Dakotas, who in this last year finally got an awesome crop. They have more feed than they know what to do with. A lot of the demand for feeders was coming from that part of the world. They were very, very bullish because they had, in my mind, almost free feed. Because they were getting 190 bushel corn on crops on acres that averaged 120. Piles of corn everywhere in eastern South Dakota. The one thing that we all said, which is what Jayme spoke to and Al, is credit, capital. If you have a 1,000 head feed yard, and last year your bank said, I'm going to give you $1.2 million to fill it. I can do that last year. This year it's going to take $1.6 million. And what we're finding, probably not with U.S. Bank or with Farm Credit, but with a lot of smaller commercial banks that many of you may work with, is they're saying, well, sorry, we're only going to lend you $1.2 million. We know that probably won't fill your yards, but that's all we're comfortable doing. So that has been a real challenge for a lot of cattle feeders. Our company tends to get a phone call when those type of banks have hit their internal lending limits because of their size, because their plate is full with operating, their plate is full of term, their plate is full of real estate. And they can easily subordinate the cattle to us, and that's where we can help them out. That's where Producers gets a lot of their clients, is to more or less be an overline outlet for smaller banks. We also deal with some bigger banks in the Dakotas that just flat out say, we're going to lend him $10 million. We're not comfortable lending him $16 million, so would you guys do 6? Okay, we'll do 6. So it's a risk mitigation part on behalf of the banks as well. Excuse me? Well, he's lending $10 million in operating, term, real estate, we prefer to come in and get all the cattle if we're going to come in and do the cattle. We tend to leave the breeding stock there. They're a longer-term asset that's usually termed out. We're mostly going to work with feeder cattle situation. Hogs, kind of an interesting chart. As you all know, PEDV was a big deal last winter. One of our clients was hit with it in December of 13, and his veterinarian got out there, they got it under control, they figured they lost about 4 weeks of production, which the veterinarian at the time said he got away lucky. He was fortunate. Figured it was somewhere between 5 and 7% of his annual production. If you remember at the time, the industry was kind of saying, we think this is going to hurt about 3 to 5%. And I remember sitting in Omaha with my lenders, and we were sitting there going, so the vet's saying we got away good at 5, 6, 7%, and everybody in the industry thinks it's going to be 3, 4, or 5. We all should have bought the board that day because we could have rode that thing from $90 to $130 because it was worse than 3 to 5%. And so that's why we saw that incredible spike in the spring. We leveled off a little bit, and then we ran up again in the summer. So, but I want to look at the other years because you can kind of see we spend most of our time chopping around between 65 and 90 bucks in the hog business. You looked at the board today. Cattle are down the limit. Hogs are down almost the limit. Hogs are trading between 65 and 80 bucks, even for the summer months. Carcass weights kind of trailed seasonally, but also corn was cheaper. Packers weren't taking discounts. Make them bigger. So that's what they did. This is a little bit dated now, but that was the PED case reports by week. You can see it's a cold weather disease. It tends to thrive in cold weather. Last winter, it was brutally hard on the hog industry. You can see from December 1 to basically April 15, it was terribly brutal. This was new cases. That line is every line is new cases. That's not cumulative. Real quickly, the sow pork powerhouses, sow numbers. Al and Jayme spoke to. We're going to have more pigs, and integrators are looking for places to put more pigs. 130-some thousand more sows going to be farrowed. Going to produce over 3 million more pigs, and PED's not hurting us near as bad as it was last year. So we're going to have a lot of hogs. We're going to have a lot of hogs. We're going to have a lot of hogs. Going to drag the price of cattle. Hope not, but it's probable. Hog production costs, real quick. You can see this goes all the way back to 96. You can see in 2014. This chart's dated quite a bit, and it was projecting $50 profit on pigs throughout 2014. I think that's pretty close. The projection for 2015 at $28, I think, is a little optimistic. I think that we're going to see just more pigs than what we thought, and they're going to be bigger pigs too. Meat prices, Al had this slide up. I don't think I need to go over it again. We could price ourselves into some trouble. One interesting point that came out of my meeting in California was the millennials, the 19 to 32-year-olds, or whatever the age group is, they want better food, and they're not afraid to pay for it. So they may continue to pay for these choice beef prices. They just won't buy a lot of it because they're not going to eat 16-ounce ribeyes like I like to. Risk management. I just want to go over this real quickly. The first thing you need to know is your break even. And I think it's been reiterated several times by a lot of the speakers today. If you don't know what your costs are, how do you know when to start marketing? You know, we need to understand that it's costing a lot to produce the crop. It's costing a lot to raise cattle and hogs. But you can protect yourself. You can manage that risk. Our board members, our loan volume spiked quite a bit with these increases in price, and they're like, what are we going to do? I said, we're going to keep doing what we've always done. We're going to keep hedging. We're going to keep buying options. We're going to do what we've done to manage. How many of you lost money on $2 corn and 80-cent calves? A long time ago. You did, because you didn't manage risk. So what? So you're paying $250 and you're locking them in at $1.65. You're making some money. So I want you to think about it and I'm a believer in options, especially when the market's going up, because it's easy to be a believer in options when the market's going up. But even when you could buy cattle, hogs, and you don't have a hedging profit opportunity, you're breaking even. We don't want to hedge that. So I'm asking you guys to think of it as an investment like you make in your crop insurance. You go spend $600-700 on a crop acre, and you'll spend $30 to $50 on crop insurance and don't think anything of it. So if you're going to go out and buy a 5-weight steer that costs $1,500 or an 8-weight that costs $2,000, why wouldn't you spend $25-30 on an option to protect yourself there? You're spending 3 times the money. I hope I don't upset anybody, but I want to use the phrase that there's really no excuse to lose $200 a head anymore in the cattle business. The option world is there to protect you. You may lose 50, you may lose 75, but you're being really stubborn if you just say, I'm not going to spend that money to protect $2,000 invested in a yearling. Okay? So I ask you to think about that. The last phrase there talks about the funds and what's happened in the market. To update this today, we would be at $1.50 on February from $1.72, $22 times, say, a 1,300 pounder. That's going to be $300 a head. The change in the value of that fat steer today from Thanksgiving. So less than 2 months. So when we ask for $200 a head in our custom program, I'm scratching my head going, maybe we're not asking for enough. But we really want to encourage you to think about risk management. Understanding the tools. I think most of you understand futures. You got to understand basis. I just explained an awesome example on positive basis, but they also need to understand that we can have negative basis as well. Throughout the year, basis changes. Excuse me. Options we just spoke to. I like you to think about it that if your break-even's $1.60 and you're starting your tractor, loading your feed, feeding those cattle in your yard, you can probably buy a put at $1.54, $1.56, and you can pay me, you can pay the vet, you can pay the ethanol plant, you can pay everybody that's asking for a check. Because $5 or $6 that break even is probably what you're paying yourself for that yardage and your expenses that you incur on the farm. I might be wrong on that, but I think that's close. You're going to work for free if things really fall out of bed. But if things want to go to $1.75, it's all yours. That's the beauty of the option. Our vision at PMA is just to provide services that everybody would like and see and need. We've had services we've offered that no one cared for. We pulled them back off the table. We want you to use the credit. We want you to use the commodity guys. And we want you to use our marketing guys. You don't have to. If you're happy with your banker and you want to use our commodity guys for that hedge contract, that's fine with me because it's a great tool. As a banker, when I was lending the cattle money, I referred all kinds of people there. We try to do it at reasonable fees, and our ultimate goal is to help you guys make money. That's our goal. And I put this on there just because, and it's been spoken to quite a bit this morning and today already, is about change. Change is the law of life. Those who look only to the past or present are certain to miss the future. We don't farm with horses anymore. We don't bin run our beans or corn. Cattle industry, hog industry, all these industries are changing all the time. I think some great advice was given this morning to have these management teams surrounding you because they're going to be going to places that get you information you wouldn't have gotten if you were out there choring all by yourself and bringing you information that you need. Here's our contact information. Our website's on top. Phone numbers for our different divisions. There's my email and my Twitter account. I'm not much of a tweeter. I forward on a lot of things that I find that are interesting. I follow a lot of people that I like their opinion or I like what they're posting, and I put it out that way. But enjoyed the time here today. If you do have questions, obviously we're going to do some questions, but thank you very much.
Okay, thank you very much, Tim and Jayme and Al. I think now we'd like to open it up for a few questions from the audience. If you've got a question, please raise your hand and we'll get a staff person around with a microphone so we can make sure we capture this for the video. Any questions for this panel? They shared a lot of great information. There's a lot of good years of wisdom up here in the lending and banking industry. So if you got a question, please ask. Well, maybe while you guys think about a question, I guess I'll start with a general one. And I think, Tim, you certainly drove this point home. But what, in each of yours opinion, is one tool or service that farmers should be using but aren't today on the farm with livestock?
Have at that and go first. And I think it comes back to your record keeping. We still have too many people that come into their lender, whether it's Jayme or ourselves, and they do their balance sheet once a year. In some cases, banker doesn't even return it to them. If they do, doesn't even look at it, and that's really their evaluation tool to see how they did in their operation during that whole year. And this has gotten to be a big business. Look at the investment we have in cattle, the investment that we got to raise an acre of corn. It's a big business today, and we got to become really diligent on our financial management. You probably need to, again, like Tim just said about spending a little bit of money, you probably need to spend a little money to have somebody professionally help you with your record keeping. Get on an accrual system that tells you from January 1 to December 31 or whatever your fiscal year is, did I make money that year? And then you don't have to go in and wonder what the banker's going to say. You can go in and present it to them and tell them how your operation did and what your plans are for the future.
I would say one of the biggest things I'm seeing is just lack of, on the hedging side and the risk management. I think there's a lot of opportunity to, even if you're not protecting a profit, just to protect your bottom end so that, just like crop insurance, it's not there to make you whole, but it's there to keep you from losing the farm. So, I mean, if you look at the pattern of how many times livestock's making money on the feeding side, it makes me wonder why we even do it if we're only making money 35% of the time. But that being said, there's always opportunity in the market to at least lock in a break even or maybe slight profit. It's just a matter of getting over that mentality of spending some money, taking out the risk protection, and also a little bit of understanding that a hedge position is not meant to make you money as well as the livestock position. I worked with a large cattle feeder one time, and I asked him his risk management strategy, and he said, well, I don't do anything. And he is feeding 5,000 head of cattle, and I said, well, how can you not do this? And we talked a little bit about options, and as soon as I said the word option, he said, yeah, I tried that back in '78, and it didn't work. And I thought to myself, well, here you are. You have a huge investment here. You're not supposed to make money on the option and the cattle. I mean, that's the whole idea to a hedge. So, I mean, a little bit of overcoming some of that thought process.
Yeah, I would agree. I had a guy tell me, he says, I use those options and I get so damn mad because they're always expiring worthless. I said, well, if they're worthless, your cattle went up about $10 or $20. Oh, yeah. Yeah, that's a good point. That's the idea. You don't want the option to be worth anything or you're kind of in trouble. I was driving up yesterday and I stopped and saw a client. He's a backgrounder, young guy, does a great job, and he's consistently sold his cattle in the 850 to 900 pound range. And he's a little concerned that this turn may not be so great. So he says, I think I'm just going to feed these out if I can't get what I want. I said, well, what's your break even? $1.92. I said, what are you going to base them at? Well, $8.75. I said, and what was the price you were offered? $2.05. And I said, that's $113 a head profit. And why are we still talking about this? Get on the phone and call that guy back. But that's kind of the mentality that the last 16, 18 months has gotten into some people's heads. They're thinking, this thing's just good. They're kind of perma-bulls. They want it to stay good. And, he says, I want what I want. I said, you know what? You got to take what they're giving you, and that's a damn good profit right there.
Got a question back there?
Yeah, but I have a couple things to talk about on this risk management. You know, a couple years ago, we suffered in the grain business of the huge margin calls. And speaking with the beef producers, or the Cattlemen's Association today in Iowa, we're having the same trouble with huge margin calls in this industry now. You gentlemen, how do you approach them large margin calls, and how do you protect your producers? And then I have another point that I would like to raise, that I think a lot of the people that are here, if you're going to use the commodities, which is a great product to use, needs to become more educated in how that industry is regulated and how you are protected in that industry. I invite you to look on the Farm Bureau page about an issue raising on that.
Well, I spoke to margin calls a little bit at our company. When we have people using the hedge contract, we pay those margin calls for you. And like I said, last October, our company had $50 million out of margin calls that we paid for our clients. Today, we don't have any, because the market has retraced so far that we've recovered all of our money. We actually have money in the bank. So you've got to have lenders, local lenders, that understand how hedging works. I've heard stories from clients in the Dakotas who they went into their bank and the market was up, $10, $20, and they were wanting them to liquidate those hedges, and they didn't understand that the cattle were gaining value in the yard. So you got to be at a bank, be it with Jayme, be with Al, that understand that the reason the margin call is being made is because that commodity is sold and the product in the yard is going up with it.
I would concur. You have to have a lender who understands the margin position. I mean, that's going to be step number one. And we work with a lot of people who do a lot of hedging. So, I mean, we understand that hedge position. The fear I always have is if the farmer decides that they don't understand the hedge position, and a true hedge is when you're making those margin calls, you have to stay the course. I've seen a lot of people who turn hedging into speculating when they don't want to make the margin call anymore, and they get out of their position too soon, and they're not selling the commodity, whether it be the cattle, the corn, the beans, at the same time, and then all of a sudden that margin call becomes a true cost because they got maybe whammied on both sides of it. They lifted the hedge too soon, and then the actual commodity went the other way on them. So it's kind of a two-way street there. I mean, you need the lender who understands it, but then you also need to make sure that as a producer, you understand that the margin calls, again, back to your point, is they're not bad, because that means your corresponding commodity is gaining in value if you're in the right hedge position.
We don't have as many young people on the farm today as we did 20 and 30 years ago. And we don't have as many ag lenders that understand agriculture as we did then either. And that's critical for you all. Find one that knows it, because whatever you're doing today, it's going to cycle. And there will be times you'll lose money. And they've got to understand things like hedging and why you got to stay in it. And they got to understand how you get through 15 and 16 and 17 when quite frankly, we might not make any money in the grain industry. And if a lender's scared by that, they're probably not a good lender. What you got to do is figure out how you manage through it. So find that lender. They're out there, but they are harder to find.
Any other questions from the audience right now? I guess I've got another one, and that would be, what's the best piece of advice you can offer a new or beginning farmer in looking ahead the next few years?
Well, I think the best piece of advice is really to understand that there's a tremendous amount of opportunity in agriculture over this next generation. I mean, we've seen the stats. We have to grow a lot of food. There are areas in the world that have some ground that can come into production. Africa is a big place where they could bring a lot of ground into production. Unfortunately, it's hard to grow food when someone's shooting at you. So, they're going to have to get some political stability in those regions before they can become real potential growers. But in the meantime, I think for our young producers, you have to have a positive outlook and a business mentality that there is I think there's a tremendous amount of opportunity, whether even on the grain side. I mean, I know we're talking about the cycle in grain, but cycle. Eventually, there will be opportunity there again, too. So it's about having a positive outlook. It's about having a good, solid business plan and being ready to execute on that.
I would speak to communication. Communication with your lender, communication with your landlords, communication with your family, communication with your wife. You know, you need to have excellent communication skills today in agriculture, because if you hole up and don't talk to people, nobody knows what you're thinking. You maybe have an expectation nobody knows what about. So communicate, you know, get it on the table, put it, and you know, Dr. Cole, what, 4% of people put their goals on paper? Be one of those 4%. Get it on paper and share it with people that are going to help you reach those goals.
You know, I think it's just important for our young people to network together with your neighbors and your friends. There's nothing cheap about getting involved in agriculture today, whether it's grain or livestock. Look at putting up some of these livestock facilities, feeding some cattle, raising an acre of corn. There's nothing cheap about it. So we got to form some partnerships. You know, 50 years ago, we all worked together. We had neighbors, we shared labor, we shared equipment. You know, there's a period we got away from that. I think there's more that we can do. So look for those opportunities. Find the grain farmer that needs to restore some working capital, that's willing to sell off 5 or 10 acres so you can put your livestock facility there. They want the manure. You've got the labor to provide. Those are great arrangements that you can do. So that networking piece is so important. And then the other thing I'd say is family living and controlling all your expenses, but certainly family living. You know, the last 5 years, as young people got into grain farming the last 5 years, great times. We made a lot of money. Unfortunately, it drove our living a little bit high too. And Dr. Cole said this morning, every dollar you don't spend on your family living is a dollar you have to reinvest in your business. That's a great point.
Any other questions for the panel? Okay, well, let's give this panel a big round of applause, please. And yeah, you guys want to take a seat? And thank you again. And on behalf of the Coalition to Support Iowa's Farmers, myself and Kent and Rita, we just again want to thank everybody for coming out today. We really hope that you found this conference engaging, informative, and inspiring, and also hope that you leave here today feeling optimistic about the future of livestock production in the state of Iowa. Hopefully, some of the information that was shared today you can take back, implement on your own farm, you know, not only for yourself, but future generations that will be on that farm as well. And again, just want to remind everybody that the presentations today, the panel discussions, the breakouts will all be available on our website in the coming weeks. So visit supportfarmers.com for that. There's information in those packets today containing all proceedings from today, but as well as, again, contact information for the three of us. If you have any questions for the Coalition, how we can help you get started in raising livestock, maybe come out, provide that second set of eyes to your farm, interpret rules and regulations, talk to your neighbors, or develop a plan for you to talk to your neighbors, plant trees and shrubs, make some windbreaks around your livestock. We are certainly here to help you. And again, that's all due to the generous support of Iowa's commodity groups that allow us to come out at no charge and completely confidential. So feel free to grab Kent, Rita, or myself today, or give us a call anytime. And, you know, again, it's a real partnership that we have here at the Coalition with those commodity groups, but also even other partners that help make our work possible, whether it be Farm Credit Services, Alliant Energy, Iowa Farmer Today, Big Gain, the Mash-Offs, Iowa Beef Systems. I know all those folks are here today. But again, it's a real team effort that we put together here in the state of Iowa to keep livestock growing. And again, would encourage you to go to our website and see some of that new economic data that's available for your county. Share that within your community, to the school board, the church board, anybody that'll listen to you about the importance of livestock, so we can keep that foundation there and keep livestock numbers growing in the state of Iowa. One more piece of homework for you. In those packets, there is an evaluation sheet. I would just ask that you please fill that out. There's a drop box on your way out the door. You can put that evaluation sheet in there as well as your name badge. And again, just want to thank everyone for coming out today, and please have a safe trip home. Thank you.